In Nepal's economy, there is a massive volume of potential energy locked away in thousands of individual deposit accounts. But right down the road from those accounts, local enterprises are starved for the capital they need to grow. Because the national financial landscape lacks highly liquid capital markets, household wealth does not flow directly into business investments. It sits dormant as savings. For regional businesses, this creates a hard ceiling. An agro-processing company in Birgunj might have strong consumer demand, but without access to those scattered funds, they cannot buy the machinery or maintain the inventory needed to scale their operations. There has to be a physical and legal mechanism to bridge this gap. Something must connect the isolated domain of public savings with the domain of commercial enterprise. Without a centralized system to route these funds, national wealth remains idle. The broader economy freezes in a state of unrealized potential. That structural bridge is the network of banks and financial institutions. Commercial banks, development banks, and finance companies exist strictly to solve this disconnect. These institutions gather highly fragmented public funds from individual depositors and consolidate them into a singular, massive pool of deployable capital. This immense consolidation of public wealth operates under the strict regulatory oversight of Nepal Rashtra Bank. As a banker or credit officer, your daily micro-decisions dictate exactly where this consolidated capital flows. Loan appraisal is often mistaken for a commercial sales function. It is a critical macroeconomic routing protocol. BFI intermediation is the engine of national economic development. The operational rigor you apply to evaluating credit directly determines the stability of the entire system. This network graph shows how BFIs hold the primary capital pool. By directing capital to specific nodes, their allocation choices decide which industries scale. At the micro level, sending capital to that Birgunj agro-processor allows them to purchase heavy machinery and expand distribution. At the macro level, extending credit outside major urban centers forces regional business development. It counters economic concentration by pushing resources into secondary cities and emerging markets. When targeted lending flows into the agricultural sector, it directly improves rural productivity and strengthens food security. Conversely, directing financing toward the urban service sector accelerates employment generation and increases the daily velocity of trade. If these routing pathways are not diversified, the entire banking sector becomes vulnerable. Over-concentration in a single industry exposes the system to severe shocks if that specific sector faces a downturn. Through localized lending decisions, BFIs are actively writing Nepal's national economic development map. Deciding where capital goes is only the first step. Injecting the wrong type of capital into a business can destroy a viable operation. This timeline chart tracks an enterprise's cash flow over 5 years, overlaying different geometric blocks that represent loan types. This illustrates facility structuring, aligning a loan's mechanics with the borrower's distinct operational timeline. Working capital finance and overdraft limits are short, recurring bursts of capital. An overdraft limit is a credit facility that allows a business to withdraw funds up to an approved threshold to cover temporary cash shortfalls. They are necessary for surviving day-to-day inventory cycles. Term loans serve a different purpose. These are massive, sustained blocks of long-term funding required for permanent asset creation, like buying that agro-processing machinery in Birgunj. If you fund a long-term asset, like heavy machinery, with short-term working capital, you create a duration mismatch. The business will be forced to repay the loan long before the machinery has generated enough revenue, mathematically guaranteeing a default. This is why you must rigorously evaluate business feasibility, borrower capacity, and sector exposure before a single rupee moves. After disbursement, you have a second mandate: continuous monitoring. You must verify that the funds are being strictly utilized for their approved structural purpose. Proper facility structuring and relentless post-disbursement monitoring are the two primary defenses maintaining asset quality across the entire banking system. Lending activities are the primary engine for BFI income. Interest earnings fund the institution's ability to operate and expand. At the same time, lending is the single largest vector for institutional risk. This balance scale illustrates the core tension of banking. You must aggressively lend out funds to generate profit, represented by the heavy weights, while simultaneously holding enough liquid cash, the fast-moving particles, to honor daily depositor withdrawals. The mix of short-term and long-term facilities you approve directly dictates the real-time balance of this macroeconomic scale. Undisciplined allocation creates non-performing loans, or NPLs. An NPL is a bank loan that is subject to late repayment or is unlikely to be repaid by the borrower in full. As NPLs rise, those heavy assets on your balance sheet become dead weight. They generate no income and immediately choke the institution's liquidity position. Maintaining strict discipline in credit allocation is the exact mechanism that preserves BFI solvency. What happens when the operational rigor of this bridge breaks down at scale? Lax assessment leads directly to misallocated capital. Productive sectors are starved of the growth funds they need. As those poorly structured loans fail to perform, the BFI is forced to restrict all new lending to protect its dwindling liquidity. Regional business expansion halts, urban employment drops, the overall velocity of the national economy severely decelerates. A localized failure in credit intermediation rapidly infects the stability of the wider Nepalese financial ecosystem. The BFI is the sole structural mechanism capable of transforming scattered public savings into national economic power. Its success relies on three pillars: guiding sectoral development, matching facility structures to business cycles, and relentlessly monitoring borrower performance. Every credit proposal you evaluate at your desk is a decision that protects depositor trust and institutional stability at the macro level. Responsible, rigorous banking is the ultimate safeguard ensuring Nepal's credit system functions safely, efficiently, and equitably for the entire nation.